It has been a challenging stretch for cryptocurrency investors, and for XRP specifically. Amid a significant collapse for Bitcoin, and consequently for the rest of the crypto market, the cross-border payments-focused token has surrendered approximately 30% of its value over the past month, even when accounting for a recent rebound. Chris Neiger, an investor who ranks among the top 1% on TipRanks, observes that as investors are increasingly gravitating away from higher-risk assets, many are left questioning XRP's trajectory over the next 3 years. While Neiger does not have a fixed price projection, he does believe the next few years could be difficult terrain for the token. For one, economic indicators are transmitting conflicting signals. Unemployment remains steady at 4.4%, yet terminations reached their highest level since 2020, and credit card and auto loan defaults have climbed to levels not witnessed since the 2008 financial crisis. In uncertain times, investors retreat from higher-risk assets like cryptocurrencies, which is why gold has surged past $5,500 per ounce, while XRP and other digital assets are declining. Rising geopolitical tensions and pressure on the Federal Reserve, from both the Trump administration's demands to reduce rates and a DOJ investigation into Chair Jerome Powell, are also fueling investor hesitation and adding strain on the Fed's independence. All of this uncertainty has been sufficient to push XRP and other cryptocurrencies lower, and could continue to do so if the economy slows or geopolitical tensions return. The 5-star investor went on to state. Now let's examine what this means from a structural perspective. The macro environment is clearly in transition. When you have stable unemployment but rising layoffs simultaneously, you're witnessing a labor market that's holding on paper but cracking beneath the surface. Companies are cutting positions even while overall employment figures remain steady. That's a classic late-cycle signal. And when you combine that with consumer credit stress, credit card delinquencies, and auto loan defaults hitting financial crisis levels, you're seeing the foundation of consumer spending begin to fracture. Consumer spending drives roughly 70% of US GDP. If credit stress intensifies, consumption slows. If consumption slows, corporate revenues compress. If revenues compress, risk assets reprice lower. This is why gold is performing so strongly. Gold doesn't offer yield. It doesn't generate cash flow. But in environments where uncertainty dominates and real yields compress, gold becomes the preferred store of value. Investors are rotating out of speculative assets and into traditional safe havens. That rotation pressures everything with beta exposure, and crypto sits at the high end of that beta spectrum. The geopolitical layer adds another dimension of uncertainty. When the administration is publicly pressuring the Federal Reserve to cut rates, while simultaneously the Department of Justice is investigating the Fed chair, you're introducing political risk into monetary policy. The Fed's credibility depends on perceived independence. If that independence appears compromised, market confidence in dollar stability weakens. Weakening dollar confidence should theoretically benefit alternative assets like Bitcoin and XRP. But in the short term, political uncertainty often dominates. Markets don't like ambiguity. They price it as risk premium, and risk premiums compress valuations. Moreover, even if the economy maintains strength over the next few years, many of the key catalysts that helped boost XRP's price following Trump's November 2024 election victory have run their course. Investor enthusiasm around XRP ETFs, which had helped Bitcoin and Ethereum gain credibility and easier access, peaked with the first XRP ETF launch in November. While the ETF still makes XRP more accessible, the initial surge tied to its debut has passed. Similarly, regulatory easing under the Trump administration and the dropping of the SEC's lawsuit against XRP creator Ripple initially boosted XRP, but those effects have largely played out. This is an important point to understand. Markets are forward-looking discounting machines. They don't price current news. They price expectations about future news. When the ETF was announced, markets priced in the institutional demand they expected would follow. When regulatory clarity arrived, markets priced in the adoption they expected would result. But once those catalysts materialize, the pricing work is done. Unless new catalysts emerge or the expected outcomes exceed initial projections, the upward momentum fades. This is why buy the rumor, sell the news exists as a trading maxim. The anticipation often generates more price movement than the actual event. So where does that leave XRP over the next 3 years? Neiger's assessment is cautious but not catastrophic. He acknowledges that if investors regain some of their risk appetite, the token could bounce back. That recovery might happen if the economy continues to grow, layoffs subside, and geopolitical tensions ease. But given the current trajectory, he believes XRP investors could experience further declines over the next 3 years. That doesn't mean XRP goes to zero. It means the path of least resistance may be lower, or at best prolonged consolidation rather than aggressive appreciation. Let's add some context to this outlook. 3-year time horizons in crypto are substantial. The entire 2018 to 2020 period was a bear market for most digital assets. Bitcoin fell from $20,000 to $3,000 and took years to recover. Ethereum similarly endured extended drawdowns. During those periods, the assets that survived were the ones with genuine utility, ongoing development, and resilient communities. XRP has demonstrated all three. Ripple continues building enterprise partnerships. The XRP ledger continues processing transactions. Institutional interest, while subdued, has not evaporated. The challenge is that utility alone doesn't guarantee price appreciation in the short to medium term. Markets can remain irrational or depressed far longer than fundamentals suggest they should. Liquidity drives price in the near term. Adoption drives price in the long term. Right now, liquidity is contracting while adoption is progressing slowly. This creates a disconnect. Long-term holders see institutional partnerships, regulatory clarity, and infrastructure development as bullish signals. Short-term traders see falling prices, weak momentum, and contracting liquidity as bearish signals. Both can be simultaneously correct depending on time horizon. If you're investing with a 3-year perspective, the question becomes, do you believe global liquidity conditions will eventually ease? Do you believe tokenization and digital asset adoption will continue expanding? Do you believe XRP's infrastructure positioning gives it durability through volatility? If the answers are yes, then current weakness represents accumulation opportunity rather than existential risk. If the answers are no or uncertain, then capital preservation becomes the priority. It's also worth noting that Neiger's caution is grounded in macroeconomic variables. Unemployment stability masking layoff surges, credit stress approaching crisis levels, geopolitical uncertainty, and Fed independence concerns. These are legitimate structural risks that affect all risk assets, not just XRP. But macro conditions are cyclical. Recessions end, credit cycles turn, geopolitical tensions ease. Central banks eventually provide accommodation when economic pain intensifies. The timing of those reversals is unpredictable, but the patterns are historical constants. The real question for XRP specifically is whether it can maintain relevance and infrastructure integration during a potentially extended downturn. Can Ripple continue securing enterprise partnerships? Can the XRP ledger continue expanding use cases? Can regulatory clarity translate into institutional adoption even in a risk-off environment? If the answer is yes, then XRP emerges from the next macro cycle in a stronger competitive position. If development stalls, partnerships evaporate, and institutional interest fades, then the structural case weakens regardless of macro recovery. Right now, we're in a phase where macro headwinds are dominating. Risk appetite is contracting, safe haven assets are outperforming, speculative assets are underperforming. That's not unique to crypto. It's affecting growth equities, high-yield credit, and emerging markets simultaneously. The difference is that crypto, and XRP within it, is still establishing legitimacy. It doesn't have decades of institutional trust. It doesn't have regulatory certainty across all jurisdictions. It doesn't have deep, stable liquidity pools that absorb volatility. That means when macro conditions deteriorate, crypto gets hit disproportionately hard. The same leverage that amplifies gains on the way up amplifies losses on the way down. And in a deleveraging environment, forced selling creates downward spirals that disconnect price from fundamental value. So Neiger's outlook, cautious, acknowledging downside risk, but not dismissing recovery potential, seems balanced. He's not calling for catastrophic collapse. He's recognizing that the path forward is likely choppy, with further downside possible before conditions stabilize. For long-term investors, this kind of environment tests conviction. It forces the question, are you investing based on narrative momentum, or are you investing based on structural adoption? If it's narrative momentum, volatility like this typically triggers exits. If it's structural adoption, volatility like this typically triggers accumulation. The next 3 years will likely separate those two groups. Traders chasing short-term gains will rotate into whatever shows momentum. Long-term allocators focused on infrastructure will continue building positions during weakness. Which strategy proves correct depends entirely on how macro conditions evolve, how regulatory frameworks develop, and how institutional adoption progresses. No one can predict those variables with certainty, but understanding the framework helps navigate the volatility with perspective rather than emotion. If you found value in today's breakdown, don't forget to like the video and subscribe. This is Wealth Wisdom, and I'll see you in the next one. This is not financial advice.